If you've been feeling whiplashed by the economy lately, you are definitely not alone. One minute we're told things are resilient and strong. The next you see these dire warnings about the housing market that make it feel like we're teetering on the edge of a cliff. So what's the real story? Are we on solid ground, or is a hard fall coming?
And this slide right here, this is the heart of the confusion. On one side, you have the FDIC, the folks who insure our bank deposits, saying the banking industry was resilient. Pretty reassuring, right? But then, on the other side, you've got housing analysts like Nick Gurley talking about a deflationary vortex. I mean, those two statements sound like they're describing completely different planets. Our job today is to figure out how both can be true at the same time, and what it all means for you. So, to get our bearings, let's start with the big official picture. We're going to look at the scorecard from the FDIC's 2025 Risk Review, which is their look back on how 2024 went. This will give us a solid baseline for everything else we're going to talk about. Okay, so the FDIC's report card for 2024 looks pretty good on the surface. Economic growth was stronger than expected, banks were making good money way above pre-pandemic levels, and things were generally stable. But, and you knew there was a but coming, they dropped this little warning in there about a deterioration in certain loan portfolios. It's kind of like getting a great report card but with a note from the teacher in the comments saying, watch out, there might be trouble ahead. And that trouble spot is where our story gets really interesting. Because, while the broad economy might look fine from 30,000 feet, the real battle, the debate that really impacts family finances and personal wealth for millions of us, it's happening in the housing market. This is where those two completely different economic realities truly collide. And that brings us to the main event, the great housing debate. Is the market heading for a major correction, maybe even a crash? Or is it going to stay surprisingly stable? Let's dig into the arguments, because both sides have some pretty powerful data. This is the multi-trillion-dollar question, isn't it? Let's play this out and look at the evidence for both sides of the coin, the case for a correction versus the case for stability. So the argument for a big correction starts with demand, or really the shocking lack of it. Look at this. Back at the peak of the frenzy, we were seeing almost 7 million home sales a year. Today, that number has absolutely cratered to just 4 million. We are bumping along the bottom at levels we haven't seen since the 2008 financial crisis. And just to put a fine point on it, this isn't some small dip we're talking about. It's a historic collapse in buyer activity. Think about it. Even with a booming stock market, the number of people who are actually willing and able to buy a house has completely fallen off a cliff. So, why? Well, it all boils down to a massive historic affordability crisis. That toxic combination of sky-high prices and high mortgage rates has just shoved millions of people out of the market. And get this stat, first-time buyers now make up the smallest slice of the market in over 40 years. The entire next generation of home buyers is basically being locked out, and that creates a huge problem for the future of the market. But here comes the powerful counter-argument. The people saying, hold on, this isn't 2008, have a very, very strong point. Back in 2006, getting a mortgage was ridiculously easy. I mean, the credit availability index was over 850. Today, that same index is near its lowest point in more than a decade. Lending standards are tight. That means we don't have a market flooded with bad loans made to people who couldn't afford them. Another huge factor propping up prices is what's called the lock-in effect. Just think about it. There are millions of homeowners sitting on these incredible 2, 3, or 4% mortgages. It makes absolutely zero financial sense for them to sell their home and give up that amazing cheap debt only to buy a new place at 6 or 7%. This keeps the supply of homes for sale incredibly low. And here's the other big difference from 2008. There is no wave of foreclosures coming. Not even close. The share of mortgages in foreclosure is just 0.5%. That's a tiny, historically low number. Most homeowners have jobs, they have a ton of equity in their homes, and they are not being forced to sell. That prevents the kind of fire sale and price collapse we saw last time. Okay, let's put it all side by side. The bears, who are arguing for a correction, they point to rising inventory in hot markets, builders slashing prices, that 30-year low in demand, and slowing rent growth. But the bulls, who argue for stability, they fire back with a lock-in effect. Super low foreclosures, tight lending standards, and steady wage growth. You can see why this is such a fierce debate, right? Both sides are armed with very real data to back up their claims. So, with the housing market caught in this bizarre tug of war, we need to zoom back out, Because this whole debate isn't happening in a vacuum. There are other risks lurking in the broader economy that could absolutely tip the scales one way or the other. Hey, remember that little note from the teacher on the economy's report card? Well, this is one of the big ones. The FDIC is openly worried about commercial real estate. With remote work here to stay, office buildings are really struggling, and the number of property owners falling behind on their loans is starting to tick up. It's a slow-moving problem, but it's a huge, multi-billion-dollar headache for the banks holding those loans. And it's not just commercial buildings. Regular American consumers are feeling the pinch too. Delinquency rates, that's people being late on their bills, for credit cards and auto loans are now climbing above where they were before the pandemic. That's a huge red flag. It tells us that for a lot of families, that financial cushion from the pandemic is gone, and they're really starting to struggle to make ends meet. Now, let's talk about a risk you might not have heard of: private credit. You could almost think of it as a shadow banking system. It's basically a ton of lending that's happening outside of the normal, highly regulated banks. It has absolutely exploded in size since 2008, but because it's all private, we don't have a very clear picture of the risks that are building up inside of it. And get a load of this number from the FDIC. Bank lending to these non-bank lenders has grown at a compound rate of 22% a year since 2010. That is an unbelievably explosive growth rate. It points to a rapid buildup of debt and risk in a corner of the financial system that regulators can't really see into, and that is always, always a cause for concern. Okay, so we've looked at the official report card, we've gone deep on the great housing debate, and we've uncovered some pretty serious-looking cracks under the surface. So how in the world do we put this all together? What should you actually be watching to make sense of where we're headed?
The key to understanding all of this is the idea of a K-shaped market. You know how the two arms of the letter K point in different directions? That's exactly what's happening. The experience of an affluent, older homeowner with a pile of money in the stock market is going in one direction, up. But the experience of a younger, first-time buyer struggling with high costs is going in the other direction, down. This explains how prices can stay high even when demand for most people is so low. It's the top of the K that's keeping things afloat. So to cut through all the noise, here are 3 simple things to keep your eye on. First, housing inventory in your local market. Are more homes for sale popping up? That is the #1 signal for where prices are going next. Second, mortgage rates. Do they keep falling, maybe unlocking some of those homeowners from the lock-in effect? And third, the job market. A strong job market has been the bedrock of this whole thing. If that starts to crack, the entire picture could change very, very quickly. And all of that leaves us right here with this final question. We have an economy that is just full of contradictions. It's resilient, but it's stressed. It's stable, but it has this historic affordability crisis. The big question for 2026 and beyond is whether all these tensions can resolve themselves gently in a so-called soft landing, or if something eventually has to break, leading to a much harder fall.